Well, constructing a superior risk-adjusted return where you're looking at increasing returns whilst reducing risk has become quite the challenge in the current market environment where risk has essentially been redefined. Earlier, I asked Maarten, Ackerman, investment strategist at Citadel, to elaborate on the new definition of risk as he sees it.
Now that we're seeing negative interest rates in large parts of the Western world, we used to talk about fixed income as your risk-free. The fact that governments guarantee payment over time, so that's why there's almost no risk. And typically this acted as a good diversifier to equity portfolio because it tended to behave different from equity over time. Now where we are today, we know that these governments are offering negative yields, so there's no incentive to save. And the only certainty is that you'll get back less over an investment period than what you give them today. So for us, that means there is no return and significantly more risk. And the risk is the fact that if interest rates actually increase even slightly, you'll make a capital loss. And if you earn nothing on your investment, you will definitely end up below inflation over time, which means that you will get poorer every day. So that's why we say that the traditional risk-free today unfortunately changed to return-free, with actually a lot of risk when you include that in your portfolio.
And still, Maarten, we see investors buying up negative interest rate bonds for a guaranteed loss, while equities are boasting modest earning returns as well, presumably because the old definitions of asset class risk still hold and are still being applied. So is it a time now for a shift in investor mindset?
I definitely think so. If you do have the ability to look for alternatives, then one would argue that getting nothing with any bank today is not a good investment. If you look at some of the global companies, yes, it is more volatile, but over time, so if you take a 10-year view, if you buy a Japanese or a German government bond today, you're guaranteed a negative return or less return of your capital 10 years later. Where most companies you can still get a reasoned dividend of 3%, maybe 4%. Over time, you're also probably going to get some capital appreciation. So equity is still a position to offer you not only the dividend, but also some capital appreciation. And as a result, you're likely to end up quite handsomely above inflation. So I do think investors should think about alternatives. Traditionally, you can't just sit in cash anymore. You'll definitely get poorer on a daily basis, and you need to find alternative diversifiers to reduce risk or equity risk in your portfolio.
One of the big problems seems to be investors' inability to disassociate volatility from risk.
Yes, I think there's various definitions for risk. Volatility is one of those, which means the swing in your value of your portfolio or your investment. But for us, risk is more the permanent loss of capital. And I think that is exactly what negative interest rate bonds are offering right now, because it's a permanent loss of the potential to earn anything on the capital. You're guaranteed to get less capital back 10 years down the line. So investors should be able to stomach some volatility in equity markets for much better yield. And if I want to reduce the risk in that portfolio, there's alternatives like hedge funds, even gold these days, maybe some protection over your equity portfolio that can achieve similar superior risk-adjusted returns than what we were able to achieve historically by adding some cash or fixed income to a traditional equity portfolio.
Yeah. Of course, let's take a step back here and take a look at how this has all been triggered, Maarten, because it's a QE at play pushed by major central banks across the world. So how are you rating central bank success in stimulating spending and discouraging savings? And do you see the negative interest rate environment actually doing that as investors come to this realization?
Yes, I think this is still a symptom of the 2008 financial crisis, where central banks tried to stimulate global economic growth. They've achieved a little bit of that, but we're still dealing with way below capacity growth in many parts of the world. I think especially after the referendum outcome in the UK, there's now bigger concern that global growth is going to be softer for longer. So we're probably at the end of the runway. The first thing they did was to reduce interest rates to zero. Then those types of quantitative easing where they actually try and create incentives for banks to put more money in customers' pockets through loans. which didn't work because I think a lot of customers actually tried to rather pay back debt. And now we're at the negative rate policy where they actually charge you to keep any money in the bank. So it is definitely, like you said, no incentive to save, but rather to spend. Again, in the hope that by spending the money, we'll see some increase in demand, economic growth, and potentially inflation longer term. But once again, investors seems to rather pay back debt, if that's still the case, or look for alternatives. And that's partly the explanation why, since we adopted these policies, we've seen a rebound again in risky assets and also some money returning to a lot of emerging markets, including South Africa.
Yeah, I asked you whether you see success in the negative interest rate environment, as central banks attempt to drive inflation, because already we see credit creation beginning in the US and Europe. So is it still too much of an early day scenario to call that success just yet?
Yeah, I think, from quantitative easing to negative interest rate policy, it's part of an experiment, if you like, that we're seeing for the first time ever. It's very difficult to call it a success or not. I think if you argue that, yes, central banks did achieve one thing, and that's preventing the world falling back into a depression like we had in the 1930s. So on that account, it's definitely been a success, although, they probably hope for faster growth, more quicker. But I think the concern right now is the unintended consequences that might still surface over the next, call it 5 to 10 years, when some of these negative rates needs to normalize, maybe not back to the previous levels we've seen, but any increase in interest rate should have a significant impact on prices going forward. So some success, definitely so, but I think the concern is about how do we unravel this experiment going forward and what might surface as a result of that.
Well, that was Maarten Ackerman, investment strategist at Citadel. After the break, it's Share My Portfolio with Stephen Sodanko.